In terms of this video, we will be using these listed rates. However, we are aware that these rates can change significantly between now and May 2nd, and thus before the real simulation, we will reevaluate these rates before pricing our stocks. Based on the trends from the past year, the US dollar has depreciated against the Japanese yen. Thus, in our simulations, if the Japanese yen continues to appreciate, we will sell short the US dollar in order to obtain more Japanese yen. In the beginning of the year, the US dollar and the Great Britain pound spot exchange rate was 0.65. Currently, it has raised to 0.7, which means that the US dollar has appreciated against the Great Britain pound. We will monitor this relationship in the simulation, and if it continues along this trend, we will buy more US dollar in exchange for less Great Britain pound. Within the past year, the US dollar and the Australian dollar exchange rate has fluctuated more than the other currencies we are comparing for this simulation. In the past 3 months, the US dollar has depreciated against the Australian dollar. We will monitor this relationship closely during the simulation since its relationship has fluctuated greatly. However, if the US dollar continues to depreciate against the Australian dollar, we will sell our US dollar in exchange for more Australian dollar. Additionally, Australia is about to fix their interest rate at 2%, and this may come into play during the simulation, adding to the need to monitor this exchange rate closely. In terms of the US dollar and the euro exchange rate for the past year, it has also fluctuated greatly. However, for the past 5 months, the US dollar has depreciated significantly against the euro. Thus, just with the Japanese yen on the Australian dollar, if our simulation follows this trend, we will sell the US dollar in favor of more euros. This past August, the People's Bank of China devalued the Chinese yuan in order to boost the Chinese economy. This led to a dramatic appreciation of the US dollar against the Chinese yuan. Since January, there's been a slight depreciation of the US dollar against the Chinese yuan. If this trend follows suit in the simulation, we will most likely shy away from doing any transactions with this exchange rate, since it would be hard to make a profit without any fluctuations. For our first strategy, we'll use UIP. This form of arbitrage we are using for this theory involves us changing the domestic currency with a lower interest rate and exchanging it for a foreign currency for a higher rate. The US dollar carries a 0.5% interest rate, Australia carries a 2% interest rate, and China carries a 4.35% interest rate. With this strategy, we will convert our domestic currency into these foreign currencies as long as the US dollar is expected to depreciate against these foreign currencies. However, if the foreign currencies begin to appreciate, we will swap back our domestic currencies to avoid losses. Lastly, we will also use PPP and the law of one price. Since each group in the simulation will have different bid-ask spreads, we can utilize these differences to our advantage to find arbitrage opportunities. We will purchase the currencies that are undervalued by groups and sell them at a higher bid price. Based off the practice simulation, we know that many groups use this strategy, and so we need to ensure that our group's pricing is not one of the lowest ask prices or one of the highest bid prices.